Hello, good morning, everyone. Welcome to all of you for today's session. Students, just let me know whether you people can hear me well.
Yes.
Right. Yes, please. Others, can you hear me? All of you? Okay, now, so students, in the last class, yes, we covered value at risk, expected value as well. So today's topic is we will be starting with capital rationing. We will be starting with the capital rationing and then exam kit questions, the task for today. So then when we talk about, just a minute, just 1 second, please. Okay, so the topic capital rationing. Capital rationing. What is capital rationing? Students, capital rationing is a situation where the company has limited funds for investment. Yes, means that, and majority cases it happens that companies do not have unlimited funds. We know that. Available positive NPV projects are large in number, are too many, yes, too many products. But funds for investment in projects are limited. Company cannot invest more than a certain amount. Now, so this is called capital rationing. Sources of capital rationing. Two sources are there. Means why this capital rationing arises. Sources or causes. What can be the reason? Student, the one reason is soft capital rationing. And the other one is hard capital rationing. Soft capital rationing and hard capital rationing. What the difference is? Soft capital rationing, where limitations of funds is because of internal reasons of company. Means no one has imposed any restriction on you regarding funds, except you yourself. You can go for the bank loans, but you think that, oh, cost will be high. We have to repay loan. So we don't want to accept risk. You don't want to issue shares because you think that EPS, earning per share, may be diluted. Current shareholders say, don't issue share to the market. Our control will be, we will lose our control in the company. That's the problem. So soft capitalization means you are feeling insecure by yourself. No one has done anything wrong to you. Everyone is giving to willing to invest in your company, but you yourself say no. Sorry, internal reason. Many men think that no, we may not be. If we expand, we may not be able to manage business. Hard capital rationing. This is because of reasons external to organization. Now, reasons external to organization. Hard capital. Let me open the notes and show you where this topic is. It should be around this. No? Just a minute. Where is the capital rationing? Yes, here it is. Hard capital. External factors. Stock prices are depressed. Now, depressed stock prices, what does it mean? The meaning is that the market is not valuing your share properly. Our company share worth is $10. Market is paying us $8 only. So we cannot issue shares. Government has restricted banks for lending. Restriction on the bank lending, government control. Bank says that your company is too risky. We cannot give you loan. Cost of fund is, interest rates are high. You see, I have already told you. Now, hard capital rationing and soft capital rationing. Now, students, we have discussed the sources. Now, we will be discussing the types of capital rationing. Types of capital rationing. The one is single period capital rationing. And multi-period. Single period capital rationing and multi-period capital rationing. What is single period? That capital rationing means funds limitation issue is for one accounting period only. And multi-period capital rationing, the name tells the story now, clear? Funds limitation is for number of years. Yes. For number of years. Now, Just a minute, please. Tea, morning tea. Next, students. Now, what is the problem? The challenge is challenge. Utilize available funds of company in the best way. Earn maximum NPV through the funds, through the investment of those funds. This is the target. This is the objective. This is a challenge. So now one by one, now how to do this? In other words, we need to make optimum investment plan. What is the optimum investment plan? Through the NP will become maximized. Best investment plan. So single period capital, one by one. What is happening? Just a minute. Oh my God. Just a minute, student. It is with some problem. Okay, closed. Okay, students, now. The point is single period capital rationing. In the case of single period capital rationing, how to make optimum investment plan? Students, there may be, again, two cases may be there. Available projects, positive NPV projects are divisible or indivisible or indivisible. Two possibilities are there. Now, if they are divisible, then we have to choose projects through profitability indexed method. If they are indivisible, choose projects through trial and error, forming different combinations within available funds. How to do it, I will explain, don't you worry. Now, let us take an example. project, investment, NPV. For example, project A, B, C, and D. Okay. 4 available projects. Investment required is 1200, 400 million, 700 million, and 500 million. Okay, make it 550 million. NPV, I'm taking assumed figure just to help you to understand the concept. Just assume figure. These are the NPVs of the projects. Now, I will solve it assuming available funds. Available funds are 1300 million. Yes. Choose best project combination if projects are A, divisible, B, indivisible, divisible or indivisible. Yes. So, कैसे? Projects are divisible. I will simply copy it from here. Here we are. We say profitability index. What is profitability index? Profitability index is basically equal to NPV of the project divided by investment. This is called profitability index. So we will calculate profitability index, NPV divided by investment, 1200. Yes, 110 divided by 400. 190 divided by 700. And then is 130 divided by 550. Now, this is the profitability index of the 4 projects. Now, second step, we will do ranking of the projects as per the profitability index. Which of the project has the highest profitability index? Can you tell me? A, B, C, D. Which of the project has the highest profitability index? Can you tell me? Yes. Please.
B.
Project B, 0.275. It is 0.271. So B, ranking 1. Ranking 1. This is on the second, ranking 2. Third, ranking 3. And ranking 4. Basically, ranking is the order of profitability index of the projects. With the highest profitability index, ranking 1. And so on. Next, the next point is we will choose the project in this order now. Available investment is 1300. Is 1300. Now, projects. Yes. NPV. So the first choice will be project C. Investment required will be how much? This. Sorry, I'm wrong. B. B is the one, right? This. So NPV earned will be NPV earned will be this. Yes. Now, students, the next is the turn of C. Here we are. And earned NPV is this. What is the remaining investment? Remaining investment is 200. The next is the turn of project A, which requires 1200 investment. We have only 200. So project A project A, just see here, 200 in the investment in that, because projects are divisible. So students, we have investment 200. Total investment required is 1200. Now multiplied by, this is the NPV. The same proportion of NPV we will earn. It is called, yes. Now, here we go. Divisible project. Is it clear? Tell me so far. Is it clear what I have done? Now, so total NPV earned will be here. total NPV earned will be here. The best combination is that invest in projects B and C in full and part of project A to get maximum NPV of 350. It is done. Now, next. So students, if projects are divisible, so we can say the stepwise process: calculate profitability index, do the ranking, and then select projects as per ranking. That's it. Next, B part. Available projects are indivisible. So again, I will copy these projects. Yes, here we are. Available funds are 1,300. We know constraint is, this is constraints as well. Now, indivisible. Indivisible means either you will take full project, you cannot invest in part. Here we invested in part, you see here, part of the project we invested and earned NPV, which is practically not realistic. We know that. This is practically not that much realistic. Yes, it might be possible in certain circumstances. Normally, the project is a big investment. Normally, okay? But sometimes you may have to do small investments. So then divisible product is good. Now, so combinations, investment, and NPV. Combinations, investment, and NPV. Combination. Which one goes? First of all, only project A. 1,200 NPV is 300. Combination, second combination. B plus C. 700 plus 400. And NPV will be by chance. Oh my goodness. This. By chance, it is same. In exam questions, it will not be like that. Okay. Now, B plus D. Investment 400 plus D 500, 550. And NPV is B plus D. Then C plus D. Is it possible within combination? 700 plus 550. Yes, it is within the investment. Available is this. So all are under 1300 combinations. C plus D. Now tell me, any other combination, A plus D we cannot do. A plus B, A plus C, why we cannot do? Because with the A, if we add any project, that will cross the total available funds. We cannot do that. So the best combination is this. The best combination is C and D projects to get maximum NPV with investment of 50 million. The remaining funds of 50 million. Sorry. With the investment of 1250 million. Yes. The remaining funds of 50 million can be invested by company in government securities. Now, my question from you is, where this 50 came from? This 50. My question from you.
1300 minus the 1250 investment.
Exactly. 1300 minus investment, which we are suggesting. Now, next. It is done. So students, this is the indivisible projects and making the combination. I hope it is clear. Let us go to the notes once again. Yes. Divisible projects and indivisible projects. Problems of profitability index. Yes, it can be used in the divisible projects only. Yes, variation in cash flows. It does not consider that the NPV is based on cash flows, on the basis of which it is calculated. Cash flows are future cash flows and may not get the same what we are predicting today. Exactly. It does not consider the absolute size. What does it mean? Profitability index. We say choose this one, and it is smallest projects you see here. It did not talk about the bigger projects have other benefits attached as well, non-financial benefits, or even indirect benefit to the business in other ways. Business bargaining power increase, business people confidence, public confidence increase when you are doing big projects. Investors' confidence improve, and you get number of benefits because of the bigger projects, which is ignoring. It does not consider the size of the project. Exactly. Now, example is given. You can read these as well. Yes, it has been solved here. Now, the next is multi-period capital rationing. Yeah. So students, multi-period capital rationing. When funds limitation is for multiple. So now the challenge is the same. This is the challenge. Funds limitation condition is for a number of years. Now what to do? What to do now? How to choose best combination under multi-cap. So students, in the multi-period capital rationing, capital rationing, projects are chosen and decisions are made through linear programming. Linear programming. Example is given, I think, in the notes. Instead of crafting a new example, I will discuss the same. Yes. So this is the projects A, B, C, D. Investments have to be made for 3 years like this in the A project. In the B, these are investments. And this is the NPV. Funds available in year 0, 40,000. Year 1, 35,000. 42,500. Yes. Calculate the optimum mix. Now, students, what to do now? You see here, first of all, we need to decide objective function. Define the objective function. Objective means purpose. What is the purpose? What is the target? Maximize NPV. Maximize NPV. So NPV of project A, NPV of project B, maximize. So this is the objective function. NPV of project A, 20,000 of A, 27,500 of B, C, and D. So maximize. Now, the second is defined constraints, funds limitation. We have 17,500 for project A in year 0. We need investment over there in product A. We need investment in product B. 0 investment for product C. And this investment for project D. Add these 3, it should be less than or equal to 40,000. year 0 constraint. Product A, product B, and product D, because C is 0 investment. It should be less than or equal to 40,000. Up till now, is it these two statements, mathematical functions are clear? Maximize and year 0. Tell me, is it clear? Tell me, please. Okay, so you see here, for year 2, this is the fund limitation. So, sorry, year 1, 25,000 of product A, 15,000 of product C, 15,000 of product D. Here it goes. It should be less than or equal to 35,000. Less than or equal to, yes. And then year 2, investment in 4 projects. The sum of all these should be set less than or equal to this. You can see year 2. So, students, now if projects are divisible, indivisible, or divisible, 2 possibilities are there. If they are indivisible, you can take full project or no project. Indivisible. Full, take it or leave it. So 0 or 1. 0 means you are leaving the product. 1 means you are taking the product. So A, B, C, D value will be 0 or 1. 0 or 1. But if they are divisible, then it can be between 0 and 1 as well. 0, you can leave it, or portion 0 to 1. Any ratio you can take. So 0 to 1. This is clear. Final value. You will put these 0 or 1 in the system. Yes. Is it clear to everyone? 0 to 1 and 0 and 1? 0 or 1 and 0 to 1.
Yes.
Yes, sir.
Right. Now, so another example. Student, its calculation is not part of your syllabus. Just you need to have understanding of whatever is being said. Okay, in exam, it can be tested maximum explanation. Calculation is not part of your syllabus. AFM. Another example. I want you to read it and read it till this objective functions and constraints. Yes, please. Constraints. Read it, please. And tell me, can you understand all this? Please go through it. And if it is not understandable, do let me know. If it is clear, do let me know. There is confusion, then please let me know. Yes, students, I need response from everyone. Constraints are clear to everyone? They say when the objectives and constraints are fed into the computer program, the results are y is equal to 1, y2 is equal to 2. So it means y1 and y2 will be taken full, and y product 3 and 4 will not be. So NPV will be according to when y1 and y2 will, project 1 and 2 will be selected. So project 1 and 2. So NPV will be the sum of the both. 19,000. If y3 and y4 are selected, then NP will be according to that. Yes. So you need to have this understanding of this section now. So students, now we will be going to the past exam questions, exam kit. So what I will be doing, I will be sending you the exam kit in the WhatsApp group of class. And then you can download from it and we will be solving questions from that. What is happening? Just a minute, it is uploading. Yes, I have sent that in the WhatsApp group of class. Yes, it is just Yes, sent. Now, so you can just download it in your system, exam kit, and we will start doing the question then. The first of all, we need to do question number 46, Fernhurst Company. Page 116, you can type. Please open everyone. No, you are not WhatsApp group of, in the WhatsApp group of class, Priyanka?
No.
I think, no, you are, I think they have not added the students who have not enrolled, I think. Actually, coordinator formats,
Okay.
right? So, okay, no worries. I will be sharing with you. So please do enroll during this week. Okay? Otherwise,
Yeah.
they will block your access. I'm telling you. You know, they were going to block the last week access of unenrolled. So I told them, no, please hold on one more week. Students might be getting salary this week. I know the last month of salaries when they pay fee. So let me send you. Can you drop me a text so that I can forward you via WhatsApp? You have my WhatsApp number. You have?
No.
Oh, really? So let me share my WhatsApp number. You can just drop me a text on the WhatsApp, then I will instantly forward you. Here is my WhatsApp number. This is my personal. Okay, send me, please. Okay, so students, please come to the question. Evaluate the financial acceptability of the investment in Milan and calculate and comment on the duration. Calculate the percentage change in selling price required for investment to have a zero NPV and discuss the, what is this? What he is asking us to do? Tell me.
Calculate the
What?
sensitivity of the selling price.
Say it again, please.
Calculate the sensitivity of the selling price.
Sensitivity, exactly. Sensitivity, exactly. Discuss the non-executive director's understanding of NPV, okay? And explain the importance of other measures in providing data of investments, short and long-term performance. Now it is generic question a bit. Okay, we will be talking about 25 marks. So students, please go through the questions once again. Read questions carefully. And then the scenario carefully. So that I can start. You have 5 minutes. Be quick, please. Be quick. I'm sorry, I'm sorry, I'm sorry, I'm sorry. I'm sorry. Okay, so three requirements are there. So we need to solve these questions in the Excel sheet. And the question name is Fernhurst. Yes. Fernhurst. Yes. So it is a manufacturer of mobile communication technology. It is about to launch a new communications device, the Milan, which its director believes is both more technologically advanced. Now, so and easier to use than devices currently offered by its rival. Investment in Milan. The Milan will require a major investment in facilities. Fernhurst company's directors believe that this can take place very quickly and production be started almost immediately. Fernhurst expects to sell this number of units in the Milan in the first year. Sales volume is expected to increase by this and this and this. Okay. The initial selling price in year one is this, increasing with the rate of inflation annually. Variable cost is this, fixed cost, yes. Now everything is rising with the rate of inflation. The initial investment in non-current assets is expected to be this. Fernhurst will also investment in working capital. Very good. Okay. It will increase at the start of each year by inflation rate. Marketing expenditure after post-inflation, after the launch of Milan, right? The marketing spend can be assumed made at the end of year one and be tax allowable expense. Good. Tax rate is this. Same year. Tax allowable depreciation is reducing balance basis. Right. Residual value is zero. Inflation is here. Right. So let us, very good, very nice. Now, so students, we will start with the working. So you know that what is the most adjustment? What are the most adjustment? Inflation. Everything is inflating with the rate of inflation. You see here. Okay, so we have to do for that adjustment. Sales first of all, working one. Sales working one. Students, year 1, 2, 3, and 4. Units. Units. How many units they say they will be selling? 132 500 in the first year. And then 20% in year 2 increase. This into 20%. Sorry. This into 1.2%. 1.2. 20%. 20% increase, 1.2. Then 30% in the next year. then the same in the year 4 as year 3. Same year 4 as in the year 3. Yes. So students, I hope you are able to understand this working. Now everything has to be done like this. The selling price. Now I will write the inflation rates here as well. Inflation, annual inflation rates. What they are? They say is 4% in the year 1, 5% from year 2 to 4. 5%. Good. Now, so selling price per unit. Selling price in the first year is 100. Year 1 is 100. 100. Before increasing with the rate of inflation annually. Yes, in the year 1. Okay. Now, so year 1. Then is the next year selling price will be 1. Yeah. Is equal to this into 1.05. Next year. $1.05. Inflated selling price. Inflated selling price. Next. So students, the next is sales. Now focus everyone. I will repeat. I calculated number of units. I wrote the inflation rate. Then selling, this is selling price per unit in year 1 is this. In year 1, if they would have said now it is this, then we had to inflate it for year 1 as well. Then after that, it will increase with the inflation rate. Sales, selling price per unit into number of units.
I have just one question, please. Why aren't we?
Dear, your voice is distorting.
I have one question, please, for the selling price. Why aren't we inflating it with the year 1 inflation?
Because they say it is already in the terms of year 1. Where it is? Yes. They said the initial selling price in the year 1 will be this. Before, now the next afterward, it will inflate with the inflation rate. Got it? If you are getting confused, you say, I feel like that it should be inflated for year 1 as well. Because I'm not clear because of this sentence. It is causing confusion. You can say, if you are confused because of this sentence, okay, inflate for year 1 as well. And then give assumption over here. Right over there for clarity. That I am doing this because I assume that it is in 100 is in the year 1 without inflation. So it has
Okay.
to be inflated for the same year as well. Okay, then do
Yes.
it. Now, next, the variable cost per unit in the year one is this, rising by the rate of inflation. Now this is more clear, subsequently. Yes, I can say here is a bit confusion. I understand you. Now, so variable cost, working two, per unit, inflated. That is 43.68. Then rate of inflation, this into 1.05. Now total variable cost. This into number of units. Now, next. The next is fixed cost. Working three. Working three. Working three is fixed cost 900,000 in year one. Then inflated with the rate of inflation. Here we are. Working capital. Working four. They say initially in the year zero, here, total working capital required. If from year zero, they say it is 1025,000. Then increasing with the rate of inflation. In the first year, 1.04. Then 1.05. Yes, this is the working capital. So incremental working capital. You see here, incremental. This will be the outflow initial. Then new level required. Already outflow is this, incremental working capital. You are able to understand it? Tell me, are you able to understand it? What I'm doing right now? Incremental working capital. Everyone, other as well. Good. So simple is that. Finally, here, this will be the outflow, inflow. Simple is that. These are the cash flows. Cash flows, any question you can ask. Any confusion, must ask, not can, must ask. The next is capital allowances. We need to calculate working 5. Working 5, capital allowances. Here 0, yes, here 1. So written down value of machine, 16 million. Then they say you can claim capital allowance on a 20% reducing balance basis. This into 20%. Written down value, this minus this. Capital allowance, 20%. This minus this. And the whole, 0 scrap value, whole will be charged here. 0 scrap value, whole will be charged here. Now, next. Students, working has been done completely. Now we will be proceeding towards main body of the question. Yes, it is almost done. Come here. So here 0, 1, 2, 3, and 4. Sales. Simply link the cell. Less variable cost. Less variable cost. Less fixed cost. Yes, less capital allowance. Why capital allowance is being deducted? To adjust tax savings. Taxable profits. Just a minute, students. My system is hanging. So I think I need to do a restart. Just a minute, please. It's doing a problem today. less this. So taxable profits less 20% tax in the same year. This into negative 20% into this. Add back capital allowance. Initial investment 16 million. Working capital equal to yes. Working capital. I hope it is clear so far. Just a minute, students. System is hanging. I don't know why. I think it needs to restart. So just a minute. Students, okay, what I'll be doing, I'll be taking a short break as well. Unfortunately, it is doing a problem. So we will reconnect after 10 minutes. Okay, right? 10 minutes break it will be. So we will reconnect just after the 10 minutes. Okay. I will be ending the meeting and restarting my system. Thank you for your understanding.